Hello, I'm David Braun, and I'm the head of PIMCO Stable Value Portfolio Management Team. A common stable value client question is, can active management add value in a stable value portfolio? Or, given the tight investment guidelines, is it better to pursue a low-fee passive strategy? PIMCO strongly believes active management is the way to go for stable value, and here are 4 reasons why. First, volatility is on the rise. For several years, investors were lulled into complacency due to low levels of market volatility. With the shift in the Federal Reserve's monetary policy from accommodation to tightening, and with the fading impacts of fiscal stimulus, PIMCO believes that the market volatility we are beginning to see in 2018 is likely to continue. While market volatility may make it harder for investors to sleep at night, it provides an active manager the ideal environment to potentially generate excess returns, as the active manager can take advantage of market overshoots and undershoots. Second, credit risk has risen. Investment-grade corporates will always be a key asset class for stable value portfolios. However, investors need to be careful as the fundamentals have begun to deteriorate. Leverage, especially for non-financial issuers, has risen to levels not seen in decades. At the same time, spreads for generic corporate bonds are not very attractive. Thus, a passive strategy that simply buys generic corporates may be putting stable value investors in harm's way. Instead, at PIMCO, we deploy a much more active approach to credit selection. It involves robust bottom-up fundamental credit analysis combined with the willingness and ability to buy out-of-benchmark credits. We believe that a much more attractive risk-reward profile can be achieved via active credit management. Third, more constraints argues for even more active management. We all know that stable value guidelines are constrained, meaning there are tight limits on certain types of securities. If you're passively running your portfolio, how do you know you are optimizing the usage of such scarce risk budgets? Active management seeks to ensure you're getting the most out of your portfolio. This should improve your return potential and reduce the downside risk of your portfolio. Fourth, active management is not just about trading to rebalance. It's also about building a diversified portfolio. Stable value guidelines are built around generic benchmarks that are heavily concentrated in 3 types of bonds: U.S. Treasuries, agency mortgage-backed securities, and investment-grade corporates. Yet these 3 types of securities represent only a portion of the bond market and leave you with an overly concentrated risk profile. At PIMCO, we leverage our deep team of PMs and analysts to avoid commoditized, overvalued generic bonds and build you a more diversified portfolio. Diversification can be a powerful risk management tool as it reduces your risk concentrations and at the same time position you for a chance at better upside returns. So what should investors take away from this discussion? We see a market that is likely defined by higher volatility and higher levels of credit risk. We believe the unique nature of stable value guidelines argue for more, not less active management to both better manage your downside risk and to pursue upside reward.